You already have the 30-year mortgage. You signed it, the payment leaves your account every month. And somewhere in the back of your head is the thought that you would love to be done with it a whole lot sooner than the 30-year printed on that paperwork. So let's do it. On a $380,000 loan at 6.5%, there is one specific number that ends your 30-year mortgage in 15 years instead. It's $908 a month. And there are exactly two ways to get there. One of them saves you an extra $12. The other one comes with an escape hatch. And I'm going to tell you exactly what that escape hatch cost, down to the penny. $103.55 a month. By the end of this, you'll know which door is yours, and you'll know the number for your own loan, not mine. I'm a licensed mortgage originator. This is education, not financial advice on your specific loan. I keep the numbers clean. Yours may be different. The shape of it won't be. Before we get started, a quick favor, we get into it. If you've ever looked at a mortgage statement and thought there was a faster way to do this, there has to be, please tap the like button for me. It only takes a second, it's free, and on this channel, this size, it decides whether the next person would actually be able to see this video or not, staring at their amortization schedule. And subscribe if you want for more of these. Okay, here's the loan we're working with. $380,000, 30-year fixed, 6.5%. Principal and interest is $2,401.86 a month. Now, stay with me on the ugly part here. If you make that payment 360 times, the way the paperwork says, you will hand the bank about $484,669 in interest. Not total, just interest. You borrowed $380,000 and you pay back nearly $500,000, and it's front loaded. For your very first payment, the whole $2,401, $2,058 of that is interest. $343 is actually goes towards the loan. Month one, you've moved the needle $340. So why does sending extra money work so violently? Because of where it lands. Your regular payment gets sliced up by a formula, interest first and principal second. But a dollar you send on top of that payment isn't in the formula. It goes straight to the balance. And the balance is what the interest is calculated on. So that $1 doesn't just knock off the dollar you owe. It deletes every dollar of interest that dollar was ever going to generate for the rest of the loan. You're not paying the loan down, you're cutting the back end of it off. And the earlier you do it, the more of the loan is still back there to cut. Want to see how lopsided this is? On this loan, one single extra $1,000 sent one time in a month and never again erases $5,955 of future interest and takes 2 months off the end of the loan. $1,000 brought you almost $6,000. That's the whole engine right here. And it never gets better than it is today. And there's a moment inside every mortgage that almost nobody knows exists. It's the month your payment finally puts more towards the balance than it does the interest. The crossover on this loan paid the normal way, you don't reach that until month 233, 19 years and 5 months. So for the first 2/3 of the loan, most of what you send is rent money or rent on money. Now add the extra payment. The crossover jumps to month 53, 4 years and 5 months. You just pulled it forward by 15 years. That's what people mean when they say the front of the loan is where all of the leverage is. And it's why starting this in year 2 is worth so much more than starting it in year 12. So here's the number. Take that 30-year loan and finish it in 15. Your principal and interest goes from $2,401 86 to 33 10 21. That's $908 more every month for 15 years. And here's what it buys. Interest goes from $484,669 to $215,837. You save $268,000 in interest. Same house, same loan, same rate. You didn't refinance, you didn't apply for anything. Nobody pulled your credit, nobody ordered an appraisal, and no lender ever had to say yes. You just sent more money, which brings up the whole obvious question. Where does that kind of money come from? In my experience, it is almost never one big thing. It's a car loan that finally ends and you keep making that payment. Except now you make it to yourself. It's a raise you never adjusted life to. It's a side income that started as a hobby. It is the year the daycare bill stops. And here's what I'd actually tell you to do. The month one of these lands, set it up automatically before it has time to become normal spending. Because the money you never got used to having is the easiest money you will ever redirect. Almost nobody sits down and finds this in a budget. They catch it on the way past. Now, $908 a month is a real number, and I'm not going to pretend it's not. That's a 38% bigger payment than you'd be paying. For a lot of people watching this, that's not happening this year. And I want to be clear about something about that. You do not have to hit 15 to win here. Watch what a smaller number does to the same loan. $200 extra pays your loan off in 24 years, saves you $110,000. $300 extra dollars, 22 years, saves you $147,000. $500 extra dollars, and you're done in 19 years. $200,000 interest saved. Look at the curve for a second. The first few $100 does most of the work. Getting all the way to 15 is the expensive part. So if you take one thing out of this video, take that. Any amount starting now beats the perfect amount starting never. And before you send a single dollar, three things go ahead of this in line. If you're carrying credit card debt, whack it, pay it off. It comes first and it's not even close. If you do not have a few months of expenses sitting in cash, build that first. Because money you put into your mortgage is money you cannot get back. Without a lender's permission, you're not getting it. And if your employer matches retirement contributions and they're not getting the full match, take the free money first. Once those three are handled, paying down a 6.5% mortgage is a guaranteed 6.5% with no bad years and nothing to time. There's no market that has to cooperate, no fund manager who has to be right. This is generally an excellent place to put your money. And real quick, that's the whole pitch here. Today's video is brought to you by, well, the sponsor is me. There's no big sponsor, just teasing. This channel is my business. I'm a licensed mortgage broker, and this is exact conversation. Should I refinance? Should I not? Should I pay it down? Should I leave it alone? These are conversations I have every single week. Book a free call, 15 minutes. There's a link in the description and a link on the pinned comment, which is the top comment. I'll pull your actual numbers and tell you which of these doors is cheaper for you. Want your own number? My free early payoff calculator does the exact same math. There's a link to it as well in the description. It's on my website. You can scan the code on the screen or tap the link in the description in the pinned comment. All right, let's get back to it because there is a second door. I'd be doing you a disservice if I've skipped it. You could actually go get a 15-year mortgage, refinance the whole thing. As I'm recording this, a 15-year mortgage runs, we'll call it 6%. On this same $380 balance, a real 15-year loan payment is $3,206. Compare that to doing it yourself. Doing it yourself is $3,310. Refinancing is $3,206. Same finish line, same 15 years, and the refinance gets you there $104 less a month over the full 15 years. The refinance costs you about $19,000 less in interest. Take out $6,000 in closing costs, and you're still ahead by $12,600. You'd cover those closing costs in about 58 months, almost 5 years. On the spreadsheet, the refinance wins. I'm not going to spin that any other way. It's just numbers. So let's talk about the thing the spreadsheet can't see. When you refinance into a 15-year loan, $3,206 a month stops being a goal and becomes a legal obligation. During the month, you get a bonus, and just as due in the month, you get your hours cut. When you do it yourself, your legal payment is still $2,401.86. The other $908 is decisions you make 12 times a year. And any month you don't want to make it, you don't have to. No phone call, no application, and nobody running your credit. You just send the regular payment, and nobody on earth says a word to you. Now go back and look at those two payments again. $3,310 versus $3,206. The difference is $103.55. That's not a rounding error, that's just a price tag. That is exactly what you pay per month to keep the right to stop paying that much per month. So the real question was never which one saves you more money. It's this: is a payment you can cancel worth $104 a month to you? For a salaried person with a boring, stable job and a fat emergency fund, honestly, maybe not. Take the refinance and the extra 12 grand. But if you're self-employed, if you work on commission, if your income has a good month and a bad month in it, that $104 is one of the better deals you'll ever be offered. And one more thing, which people only think about once it's already happened to them. Every extra dollar you put in that house is locked inside those walls. Banks do not hand the equity back to you, to people who have lost their jobs. Cash in an account will feed you, equity will not. Now, all of that assumes door 2 is even open. And for millions of you, it's welded shut. If your rate starts with a 3 or a low 4, stop. Do not refinance. You'd be trading a 3.25% loan for something near 6. And no amount of shortening the term fixes that. Handing a lender that much more of your money. But you can still do this. Same $380,000 loan at 3.25%, your payment is $1,653.78. And finish it in 15 years, you'd send an extra $1,016 a month. That saves you $114,000 in interest. And the beautiful thing is, you keep your 3.25% the entire time. If you got a pandemic era rate, you don't have a decision to make. You have exactly one door. It's the free one, and it works. Something else, and this one surprises people. If you're already a few years into the loan, this gets cheaper, not more expensive. Take the same loan 5 years in, your balance is now $355,722. To pay it off in 15 years today, you send an extra $696 a month, not $908. And you still knock $162,000 off your interest and finish nearly 10 years early. Every year you've already paid is a year you don't have to pay back. So if you've been sitting on this idea, feeling like you've missed the window, you didn't. The window got wider for you. Let me show you what this looks like along the way. Because 15 years is an abstraction, and a balance on a statement is not. 3 years in the normal way, you owe $366,000. On the fast plan, you owe $330,000. Year 5, $355,000 versus $291,000. Year 8, and now it's getting loud, $336,000 versus $222,000. Year 12, $305,000 versus $108,000. And at year 15, one of you is finished, and the other one still owes $275,000. Sit with that one for a second. 15 years, 180 payments. You have handed the bank $432,335 and knocked off $104,000 of what you borrowed. Okay, 4 ways I've watched people mess this up. Number 1, the money doesn't go where you think it goes. If you just send extra cash, plenty of servicers will park it as an early payment towards next month, or split it across principal and interest exactly like a normal payment, and you get almost nothing out of it. Send it as a separate, clearly labeled principal-only payment. Most servicers have a box for it online. Under Regulation Z, your servicer has to credit a regular monthly payment the day it is received. But an extra payment isn't a regular payment, so it's handled under whatever instructions they publish. And if you don't follow those instructions, the rule gives you 5 days. So do this. Next month, look at your statement. Your balance should have dropped by the normal principal plus the entire extra. If it didn't, call them. Number 2, prepayment penalties are restricted, not extinct. And the internet loves to tell you they're illegal. The actual rule is narrow, and it's worth knowing. Under 12 CFR 1026.43 section G, a lender can only put a prepayment penalty on a mortgage if the rate is fixed and the loan is a qualified mortgage and it isn't a higher priced loan. It can't last past 3 years. It's capped at 2% the first 2 years and 1% the third year. And the lender has to have also offered you a version of this same loan without one. Government loans just say no, flat out. And VA's Rule 38 CFR 364311 gives the veteran the right to prepay at any time without premium or fee. If you have a conventional loan, go look at your note. Search the word prepayment. 30 seconds. Number 3, timing, and it's program specific. If you have an FHA loan that closed on or after January 21st, 2015, 24 CFR 203.558 says your servicer has to accept a prepayment at any time in any amount, no 30-day notice. And your interest has to be calculated on the actual balance as of the day the money arrives. If your FHA loan closed before the date, they can legally charge you interest through the next installment due date. And on a VA loan, that same rule I just cited, a partial payment made on a day that isn't your due date doesn't have to be credited until the next due date or 30 days, whichever is sooner. So the clean move on any of these is simple. Send the extra together with your regular payment on the due date. Number 4, and this is the one that causes arguments in my inbox. Doing this does not lower your monthly payment. Not this month, not ever. Extra principal shortens the loan. It does not shrink the bill. You still owe $2,401.86 next month and the month after that. The tool that lowers your payment is a recast in a completely different thing. It usually needs a lump sum and a fee, and government loans generally do not do it at all. If lowering your monthly is actually a goal, I've got a whole video on that one. And one honorable mention, since somebody always asks, biweekly payments, paying half your mortgage every 2 weeks sneaks in one extra full payment a year. On this loan, that's about $200 a month, and it takes you from 30 to 24 years. That's a savings of $110,525. And it's absolutely worth doing. But look at it next to the real number. Biweekly is not a 15-year plan. It's a 24-year plan. Wearing a clever hat. Don't let a payment schedule convince you you've solved this. So the call. Refinance into a real 15-year if your current rate is meaningfully above today's 15-year rate. If your income is stable and predictable, if you've got reserves to absorb a bad quarter, and if you know yourself well enough to know that if the payment isn't mandatory, you'll spend it. That's generally a great decision, and you'll be $12,000 richer for it. Do it yourself if your rate starts with a 3 or 4. If you're self-employed on commission, if your budget has one wobble in it at all, or if you're just not certain, because certainty is exactly what $104 a month is buying you, and take door 3 if neither of those is right for you. Send whatever you can, whenever you can, no plan, no commitment. $200 a month is still almost 6 years off your life. Here's what I want you to walk away with. 30-year mortgage was never a 30-year sentence. It's a 30-year maximum with a minimum payment. And you are allowed to beat both of those numbers whenever you feel like it. You can end it in 15, you can end it in 20. You can send extra $100 in the months you have it and nothing in the months you don't. And you will still finish years ahead on paper. The only version of this that fails is the one where you wait until the number is perfect. Go pull up your loan right now. Find the balance, find the rate, and find out what your number is. I'll see you in the next one.